Okay, welcome to the Chapter 12, Section 2, Payroll Deductions Presentation Lecture. In Section 2, we'll be going over deductions that come out of paychecks that are paid by the employee and by the employer. Now, when it comes to withholdings are any type of deductions that's going to come out of an employee's check. Some of them are mandated by the government, others are mandated by the organization, in which case the employee works, or it could be any type of other alternative program that the employee wishes to take part in. A deduction is an amount that is subtracted from the gross earnings. So deductions required by the federal government are federal income tax, Social Security tax, and then there's also deductions by our state and local governments, known as state and local income taxes. Now, computing employee paid withholdings, it's different per employee per amount of earnings. When it comes to federal income tax, it's based on estimated annual income. It's also, also an employer is going to withhold and send to the government. And the actual amount is determined when a tax return is finally completed. So that is the taxes that are paid when it comes to the federal income tax. Now, the amount withheld depends on three different factors. Your marital status, which means you're either single or married, which is indicated on a W-4 form. Your number of allowances, these are the number of dependents who claim stake to your income as means of survival. And then also your employee's gross earnings, the tax table. So we'll talk about that here, all examples of all of these here in just a second. Let's first take a look at the W-4 form. W-4 form is filled out every time that you begin work in a new employer or a new organization. Your employer is going to ask for this because your employer needs to know what tax rate you want to be taxed at. The number of allowances are the number of people who are going to be dependent upon your income for survival. So if you have a family, if you're by yourself, you can claim 0, and the lower the number, the higher the tax rate is going to be. So if you claim 0, you're going to estimate about 33% of your earnings is going to be taken out for taxes. Now, it doesn't mean you don't get that money back. Whatever money is taken out of your taxes, if it is declared at the end of the calendar year that you have overpaid your taxes, you will get your tax refund in the spring. So it depends on how you want your money. Do you want your money up front, or do you mind that the government takes a big chunk of it up front and then you get a nice little bonus every spring? So that's totally up to you. The larger the allowance, the less the amount that's withheld. The less the amount that's withheld is going to increase your chances of being audited and having to pay in. Now, computing employee paid withholdings. If you are tax exempt, it means that you do not have to pay taxes. There are some criteria that are involved with that to not have to pay taxes. You did not have federal income tax liability in the previous year. Expects no tax liability this year, and or has an income of less than $700. This would make you exempt from federal income tax. Now, tax tables, these are formulated by the IRS. Tables supplied by the IRS to determine the amount of federal tax withheld. And this is going to depend on your earnings. It's also going to depend upon your marital status in terms of married or single persons. And it also is going to determine what your federal income tax rate is based off of these tables and based off of your earnings. So not everybody's going to pay the same federal income tax for the same amount of earnings. Here's a pay period tax table for single persons. Over here on the left-hand side is the earnings, at least X amount of dollars, but not less than Y amount of dollars. If you fall into any of these categories, then you're going to move over to the right in terms of the number of allowances. If you are 110 to 115 and have 0 allowances, you're looking at a $9 deduction. If you are 340 to 350 and you have 0 allowances, it's a $44 deduction. If it's 1 allowance, it's a $36 deduction. And as you can see, as the allowances increase, the amount that is taken out of your check decreases. Married, if you are married, tax table is a little bit different. Here is the earnings, $330 to $340. You claim zero, $32 is coming out of your check. You claim $124, you claim $216, and so on all the way to zero. So again, as the number of allowances increase, the amount that is deducted decreases. Now, computing employee paid withholdings, these are other deductions that come out of your check. Everybody is responsible for paying into Social Security. Social Security is often referred to as FICA taxes. They provide income to retired and disabled persons and dependent children, spouse and dependent child of a deceased worker, and health insurance for the elderly. So it is a government-funded program that we all are required to pay into. Exact tax set by Congress, not based on income. Social Security tax is 6.2% of your income for that particular pay period, and then Medicare tax is 1.45%. So total FICA taxes are 7.65%. Let's take a look at calculating these taxes. If you take a look at the demo problems, problem 12.4 is just simply doing the calculation. You have the gross earnings, then you have to calculate out based off of those percentage rates how much is going to be taken out for Social Security and how much is taken out for Medicare. You would do this by calculating gross earnings times the percentage rate given for Social Security and Medicare. So take a second, give that a try, calculate out those numbers. It's relatively easy, just punching the numbers into a calculator and seeing what spits back at you. Now, computing employee paid withholdings, both entities have to pay tax, employees and employer. But when it comes to employees, there are other voluntary deductions that go along with it, such as union dues, possibly health insurance payments and premiums, life insurance payments and premiums, pension and or other retirement payment plans that you might have in place, credit union deposits, U.S. savings bonds, or even charitable contributions. A very common retirement plan that a lot of organizations use and offer their employees is what's known as a 401k plan. 401k plan is when an employee puts monies from the paycheck into an account for retirement and does not pay taxes on it until the money is taken out at a later date. In some cases, you'll have employers who will match this percentage if it stays within a certain range. So if you put 2% of your paycheck in, the employer will put 2% in also. You'll get a 4% contribution. So this concludes the presentation lecture for Section 2. Please make sure and review the slides if needed. Make sure that you are able to calculate out the federal withholding taxes, Social Security and Medicare, and then I will see you next time we meet in class.